Hello everyone, this is Gary Muir, your instructor. This video will discuss our next chapter in our payroll course. It's chapter 6, and the assignments are due after Easter, April 24th, with our exam to be completed by April 26th. So this particular chapter, I'm going to follow the PowerPoint that's here in our Blackboard shell, the slides anyway, and kind of just go over a quick review of some of those items found within the chapter. So if I bring up the chapter notes here, the basic processes or functions that we're going to do in chapter 6 is recording our payroll entries in a general journal, not only the wage or the payroll itself, but also some of those other things that we have to pay in, like our 941 deposit, and that's what the payroll taxes are about, and also recording maybe a couple of year-end or month-end accruals and a short discussion on workers' compensation. Not only do we have to journalize these entries here, but we also have to then post them to the GL accounts. And it's been a while probably since we've done this, so I do have a review on how to properly post those entries from a journal to a ledger sheet. So that'll be found later in the review here. So if I go forward here, first off, we have the payroll register. And on pages 1 and 2, if I go over that quickly here, just talks about it, and there's actually a sample at the bottom of the page, pages 1, 2, and 3, and obviously you've done those before. But I did want to mention here, it's something that we don't always hear, is that the bottom total row, we have to prove out our column totals to our row totals, and the goal is here, if you can get to that net pay both ways, going across the rows or going up and down the columns, that's called footing or proving your register. And that just kind of shows that you didn't have any math errors while you were creating your payroll register. So again, it's not a term that we use quite often anymore, really. Secondly, once the register is completed, right, we have to update the employee earning records. So there is a sample of one on page 5 of our textbook where we transfer the gross wages, each particular deduction, and also what their net pay was, and that's updated in their earning records. And remember, why do we keep that earning records? Is to do those year-end or quarter-end reports required for so many, both federal and state government requirements. So keep that in mind. Again, posting to that is explained in chapter 6. Once we have the earning record updated, at that point we make our journal entry, right? We're going to record it in our accounting system. Now obviously in a real live situation, QuickBooks, Sage, any type of accounting software program that does payroll, well, this is done automatically, but it's still a good process for us to learn what should occur, because we're responsible for that accounting information. We have to be sure that our accounting software is putting the deduction in the right spot on the general ledger, is putting the wage expense in the proper expense account, and so forth. And you can see here that we're not only recording the expense side, remember we have all these other deductions in addition to our tax deductions that have to be put into a liability account. So a current liability, right, account. Remember, we're just holding the taxes or deductions in this case, and at some point we have to pay them to the health insurance, the union dues. Maybe there's child support we have to pay in to the counties for that particular employee. So they are simply a current liability, and at that point we pay it when we're required to. Health insurance, very prominent in all of our news and so forth as far as affordability, but there is many times where we take premiums, the health premiums, out of the employee's paycheck, right? So that is again, a liability to us. And depending on who you work for, some employers will contribute toward that premium, others will not, or some will do more than others. So it's really up to the company how much they wish to contribute. So it talks a little bit about that, the employer portion there. And then garnishments. Probably the most often garnishment out there is child support, but they talk about bankruptcy, they talk about tax levies and so forth. There is a discussion here as to how much you can take out. So the author talks about disposable earnings here, and that's really the definition of disposable earnings is the gross wages minus all the taxes, both federal and state, that are deducted from the employee's paycheck. So once the taxes are done, at that point, that disposable earnings is the threshold just going to quick write this. So that's what this disposable earning is, what the percentage is based upon. So if it's $100 and my $100 of disposable earnings and it's 25% is the max that I can take out, well, that means I can take only $25 out of $100 of disposable earnings. So watch for that as it's talked about in the chapter. Know what disposable earnings is. And then some of these, like tax levies and student loans and credit card, right? A lot of employees may be in trouble on their credit card bills or behind on them. There is certain laws, and they vary by state as to how much can be taken out of their paycheck. Number one, before any deductions taken out, this is beyond the taxes now. Taxes are first. But if the employee does have, right, child support, this is number one. They have to be paid first. So once they're paid, and there can be a significant portion of the disposable earnings again that can be claimed for child support. So that's what this percentage means. It varies by state. Between 50 up to 50 or 65% of disposable earnings can be taken for child support. And then after child support, number two is any federal tax levies. And then after that, you've got some of the other, again, credit card charges and so forth that could be taken out if there is any left at that point. Switching gears here a little bit, pension. And this is discussed on page 12 of our book. And not too many employers have pensions anymore, but an example of a pension would be a 401k in which the employee contributes, right? And then also the employer may match, right? So they're talking about a match here also. These plans can be named different. Some plans are called simple IRA. The author likes to use this plan quite often. A lot of smaller companies may have a simple IRA, but that's kind of what they're talking about here. Not all employers have them. You don't have to have a pension or retirement plan. Many small ones don't, just because of the cost to maintain it. And there's a lot of requirements. You can't discriminate, right? in favor of those high pay employees versus the lower paid employees. So there has to be an even contribution or matching that the employer has to follow those certain rules. So another factor has been that a lot of these pension funds have been underfunded, not funded by the employer, and then when the employer does default or closes, there is no money for the employees. So it's nice to have, but there's a catch-22. It has been abused. That's why some companies are not offering it any further. All right, on page 13, they talk about how to pay employees. Obviously, the most common is by check. For many smaller companies, electronic, though, has been, again, more prevalent because of the ease of doing it. There's a cost savings to the company for doing it because they don't have to cut checks and so forth. And there is a safety factor here, too, where we are not having our payroll checks floating around and actually getting stolen and so forth. So it's a much more secure way of doing it. And then finally, the last choice they talk about, and I've not seen it too often around our area, but in some cases, employers pay their paychecks on a prepaid card or a debit card, and basically fill that debit card that the employee can then use for purchases. So I'm just going to kind of go through this. There is a small discussion on unclaimed paychecks. This may happen when somebody doesn't take the check, they've quit and they've left. You are required to keep it, and it says here it's at some point, and again it depends on states, that they may have to surrender it to the state. You can't just hold it forever and keep it in your safe. You really should submit it to the state. And then if that is claimed by that person 10, 20 years from now, apparently it would be there for them. So, but that depends again on what your state law does want you to do. So, once the discussion has done that, then it goes into recording the payroll entries, and they try to use T accounts first on pages 20, page 21, showing the flow, I guess you could call it, and then above it, it does show the journal entries. So please review pages 20 and through 21. It shows these entries. There's always two entries for every payroll. One, to record the gross wages and net pay. Two, to record the employer tax portion. And you'll see that on pages 20 and 21. Obviously the first one is the gross pay, then the second one is the computation of the employer tax portion. So here's our example showing what's recorded where. And a very common error here is the amount of the wage expense. That is always the gross pay. And the net pay here is always going to cash. In some cases, it may be payroll cash. A lot of employers have in their accounting system a checkbook for regular checks to vendors and a separate one for payroll checks. So basically, this is coming out of the payroll checkbooks, right? And you'll see also what's being credited. So we have our debits, and then our credits accounts are all the deductions coming out of the employee portion, right? There's no employer deduction here, just the employee portion. And these are all payable accounts. You can see the word. So these are all current liabilities. and they're defined with the proper tax name on it. For help then, basically, I can look at the balance sheet at the end of the month and exactly know what I have to pay to the Wisconsin, right, the state, withholding for that pay period and so forth. So it makes it much easier to get that information. The second entry is our employer taxes. So here are all the employer taxes. There's only 4. And that's Social Security, Medicare, the FUTA, which is federal unemployment, right? And that's always at 0.6%. And the SUTA is the state unemployment, and that percentage varies. So it depends on the employer, what their contribution rate. That's kind of what we learned in Chapter 5. Well, that is what we learned in Chapter 5. And then finally at the bottom here is the Social Security, retirement, and the employer, right, portion of health insurance, which is also known as Medicare. So I got the rates. These are percentages, all right, that we have to do or contribute for or on behalf of the employee. And the sole debit for all of these payroll taxes is called the payroll tax expense. So on page 620, actually we talked about 620 and 621. They really don't show the posting to the general ledger. So I'm going to have a problem shortly on that. So let's just quickly cover what's left in Chapter 6. Workers' comp, total employer expense. And obviously this is here because it's based upon the amount of payroll. And also, it's based upon the employee's position. So if I'm looking at a place that has welders in it, they may get charged a certain rate based on their pay because welders have more prone accidents, right, in a high-risk area maybe, as opposed to the office workers, which are very cheap insurance because they have very fewer claims, right? So, and the premium or the insurance premium, which is the expense, is based upon every $100 of payroll. And the $100 is the gross payroll. So every year, once a year, you'll have the insurance company come in, audit your payroll books, determine how much payroll was for each classification, welders, office, and then from that we'll generate a report to determine what your insurance expense will be for that year. It's done once a year. Now obviously they don't wait till the end of the year. You have to pay in based on an estimate, and then at the end of the year they just verify that you were close and then make up the difference for what you paid in compared to what it actually was. All right, so workers' comp actually is talked about on page 22. So you cannot have employees without workers' comp. The state of Wisconsin, that's illegal. So it's very important that you have that insurance in place if you do have employees. So here we have some additional computations as far as recording the payroll tax deposit. And please know this for the exam. What 3 taxes make up a 941 deposit? Well, here they are. They're all federal taxes. Social Security, Medicare, and withholding, right? FIT, federal income tax withheld from the employee's paycheck. They must have had a little move on their Word document or PowerPoint document. Obviously, we're debiting those accounts, right? We're making the balances to zero. That's the goal here with this deposit. And then we pay that into our to the IRS. The IRS gets this check through an EFTPS payment system and electronically, basically, so that we are recording this as our 941 deposit. And then the next entry, obviously, if I'm paying in my federal income tax, right, that we withheld, we also got to do that for Wisconsin. This is where the WT6 comes in for Wisconsin. That's the deposit ticket, basically. Again, we would use a Wisconsin EFTPS system to make that deposit. Again, what's the goal with the deposit? We're going to try to make that balance zero. And then finally, we could have actually two here. We could have not only SUTA for state unemployment, but we could also have FUTA tax payable for the 940 deposit. So this sometimes gets confused with a 941, but remember, 941 is for the Social Security, Medicare, and FIT, whereas the 940 is simply a federal unemployment tax in it. So obviously there wasn't any one or any amount. Maybe we're over the $7,000 wage cap for every employee, so there might not be any. But there is a SUTA one, and that's what we're doing here. We're debiting the liability. We debit that. We make that go down. So we have a zero balance owed at the end of that period. All right. So here, there is problem 9. I just thought I'd lay it out so that we could get used to our entries. So here we have our gross pay. So let's just assume this is the payroll register. And here are my employer contributions, right? And it shows my two entries. Here's my wage expense entry, my register entry. And you'll notice that I'm debiting the expense and I'm crediting all of these accounts and come up with a net pay here of $13,441. My second entry with every payroll is the expense side for the employer taxes. You'll see that I'm crediting these, right? I'm making these numbers go up because I'm increasing the tax. I'm increasing my payroll tax expense with a debit of $2,022.18. And then going on, continuing, I have my 941 deposit. What am I doing? I'm reducing these numbers with a debit entry, making my 941 deposit to the IRS for the federal taxes that were not only the employee portion, but the employer portion has to be paid at the same time. That's true of the Social Security and Medicare. Obviously, the FIT is only employee that's withheld. So we're adding not only what was added during the payroll, but also the employer matching. Going forward, we have our withholdings and then our both FUTA and SUTA deposits. These are all on the test. These are your journal entries that you have to know not only how they're created, right, through our payroll, how are they increased here with our payroll entry. So these are all credits going up. Obviously, cash is an asset, that's going down. But the rest of them are all going up. The employer portion, also contributes to that. And you'll see if I add $1,067.02 twice, I look at my deposit entry, and that's the double, 3134.04. All right, so those are the ones that we really need to know. And what I did here, guys, is I actually made the journal entries. It's been a while probably since you've done journal entries. So here we have our dates, right? Post reference. I'm just assuming it's journal page 1. And we have current debits and credits. So we credited cash, right? And we have a running balance here on the end. And obviously if I'm crediting a cash account, an asset account, it's making it go down. If I'm debiting an asset, it's going to go up, right? So, and remember, the running balance might be 2 columns. You might have a debit column and a credit column here as well. So what does an asset normally have? It normally has a debit balance. You will never ever use the credit column on an asset account. If I go forward here and look at some of the liability accounts and look at what we're seeing here, we're seeing basically a credit balance, right? So it would be on the credit side, but look at, I'm increasing it twice. My running balance is 3134. Oh, so I was wrong. If I doubled these two, I'd be at 2,134. But remember, I may have a prior balance that maybe from another payroll. So I want to make sure that I deposit all tax monies owed, and the goal here is to reach 0 after the deposit is made. So here's my 941 deposit posting showing that that tax has been fully paid at 0 balance. And if I do that for each of my accounts, I'll just keep going here. Medicare, again, what's the goal? My 941 deposit makes this balance 0. That way I know that I've made my deposit correctly, right? That I've fully paid in the amount that I should have after 1 or 2 payrolls during that period. And you can see the SIT, the FUTA, the SUTA, all are 0 once the deposit has been made. And just follow through this. You can see some of the other entries. Here's a debit to wage expense. A debit to an expense, what? Makes it go up. So that's kind of what you're seeing here. These are the completed forms. Again, you will have to do this posting process on your exam, posting into the general ledger. Here's just another example. I wanted to point out one thing here. This is problem 6-7A. The check date is our posting date, not the pay ending date. So whatever the check date says, that's the date. It's a liability for not only our employees, that's their check date, but also for us as employers, the payroll taxes are based upon that date. So here again is another example of my credits and debits, my second entry for the payroll taxes, and then my third entry here is my 941 deposit that pays in what 3 taxes? Social Security, Medicare, and FIT, federal withholding payable. All right, to end the chapter then, on page 624, 625 are the year-end or month-end adjustments. The big one is the wage expense. How do we create that accrual? We basically debit the expense, makes it go up, right? Because again, remember, cash payroll, or payroll is always based on the check date. Well, that doesn't align with our accrual accountings, right? So we have to, at the end of the month or end of the year, do a accrual entry. And if you remember from accounting 1, on the new year, new month, right, we have to reverse that entry with the wage payable, and wage expense would be credited. And this will allow us then, when we do pay our payroll in the new year, that the credit expense on the reversal will offset the gross total wages that we are going to make in, so a net. So we can easily show a certain portion of the expense in the prior year based on the days in that year, and then the other portion would be in the new year as an expense. And our second accrual is for vacation pay. A lot of companies will pay, will basically calculate vacation based upon work. So for instance, if I work a month, I get another day of vacation. So for every month I work, I accumulate days. So that's why they're recording this benefit as the employees earn them. Remember, with accrual accounting, we have to match the expense to the revenue, right? So if I'm paying employees during the month, I also have to record that expense for vacation that they will take in the future. So once the employee does take it in the future, we'll basically reduce this payable account as they use it in the future. But again, we have to match our expense with the revenue, and that's why we're making this particular entry. So 611 is my example. Here we have a wage expense, and the amount is only $13,060. How did I get that? Well, they're telling me that the gross pay for a 5-day week is $32,650, which translates to an estimate of $6,530 per day. The year ended on a Tuesday. This year ended on a Tuesday, which means I had 2 days in the old year, right? So that's what I'm accruing for, are those 2 days, totaling $13,060. Come the new year then, right, I reverse that entry, just change the account names around, and then when I do actually make the payroll entry, let's say on January 3rd, which would be Friday, I basically will debit the expense for the full amount. But remember, as my circle kind of says here, I'm going to net the 2 wage expense, and basically what am I doing? I'm going to have a wage expense for 3 days, the 3 days in the new year. So that's how the accrual reversal entry work for wage expense. It's the one main one that you will reverse, the others you don't. This is one of the ones that you will. On 46, page 46, they actually have an error here. So I want to show that here. They haven't changed it in years. But what happened in this particular problem is that they made a mistake and recorded the vacation paid to wage expense. That's what I have in red here. So to start with, we have our accrual, right? That's fine. We've debited the expense. We've credited the payable for the accrued amount, $27.90. The book tells us that number. But then when they went to pay the employees for vacation sometime in the future, instead of using the vacation benefits payable account, they incorrectly used the wage expense. That's the error. So this particular problem, well, what's the correction then? And that's what's wrong, or the answer key is wrong for this particular problem. They say the adjustment should be 740. I'm saying the amount should be actually 2,050. Remember, they totally used a wrong account here, right? For the full $2,050. So why wouldn't we fix it by using that 2,050? That's what makes no sense. They've used 740. So just be aware that if you have questions on that particular error, or this video doesn't explain it very well, just let me know. But in my mind, if I use the wrong account here, don't I have to correct it with the full amount down here? And that's what I'm actually doing. The book says it should only be 740, which is incorrect. And that's just the difference between 2790 and 2050. So keep that in mind. Let me know if you have any questions on that. I can certainly give you some guidance on that. So that's my review of Chapter 6. It's really based upon a lot of journalizing and posting, which you should be somewhat, at this point, comfortable with, hopefully. But let me know if you do have questions, and good luck on your assignments and exam. Thank you, guys.